In this video, we are going to estimate the intrinsic value of a stock using free cash flow method. Even if the stock is doing well both financially and business-wise, we need to know the right price at which we should buy it. In free cash flow method, we find the intrinsic value by determining the future growth of a company. There will be many assumptions along the road. If you want the Excel file used in this video, do let us know in the comment section. So let's get started. Number 1. Find the cash flow for the past 3 years. To calculate the future cash flow of a company, first we need the free cash flow of the last 3 years. The formula for free cash flow is cash from operating activities minus capital expenditure, which includes payments for property, plant and equipment. You can easily find this data in the annual reports of a company. After getting the free cash flow of a company for the last 3 years, find the average of this value and this will be your average cash flow. The reason we take 3 years of data and then average it out is so that extreme values in any one year can be cancelled out. This is an example with random values for you to see. You should have something like this at the end. This is the cash from operating activities. This is the payment for property, plant and equipment. Here we have subtracted them to find the free cash flow, and here is your average cash flow. Number 2. Growth rate. Now we need to assume a growth rate. As we will need future cash flows value for our calculations, we need to assume a rate at which the cash flow will grow in the future. For mature companies, the growth rate is generally assumed around 10% for the first 5 years and 5% for the next 5 years. So the free cash flow for the first year will be average cash flow into 1 plus 10%. For the second year, we will use the free cash flow of the first year, so on and so forth. You can use Excel to easily do all the calculations for you and you will have something like this at the end. Now we have the free cash flow for the next 10 years. Number 3. Terminal value. We have calculated the free cash flow for the 10 years, but what after that? The company will be still there and will keep on generating cash. We need to include this in our calculations too. The formula for calculating the terminal value will be different from calculations for the other years, as we will be calculating for infinite number of years. The value of growth rate for terminal cash flow is always assumed between 3% to 4%. We can take 3.5%. We also need to assume something called as discount rate. We'll talk about discount rate soon. For now, we can assume discount rate as 9%. The formula for terminal cash flow is free cash flow for 10th year into 1 plus 3.5% divided by 9 minus 3.5%. Number 4. Net present value. Now we have the free cash flow for the next 10 years and the terminal cash flow for 10 years and beyond. Now comes the important part. We need to find the present value of these future cash flows. Remember, $1 now has more value than $1 in say 2 years. So the free cash flow that will be generated in future needs to be converted into its present value. For this, we will be using the discount rate. We will assume the same discount rate that we assumed earlier, that is 9%. The formula for calculating the net present value is free cash flow upon 1 plus 9% raised to the year number. So for third year, it will be 3. Like this, we will have to find the net present value for all the 10 years as well as for the terminal value. For terminal value, we will use year number as 10. Number 5. The final value. Now all we need to do is sum up all the net present values. This is the total cash flow that will be generated by the company in terms of its present value. The final step is to divide this value by the number of outstanding shares and you will get your intrinsic value. Number 6. Range. While calculating the intrinsic value, we have made many assumptions. So the value is not accurate and we need to modify it a bit. Instead of taking it as a single value, we'll have to consider it as a range of values within a plus minus 10% zone. So anything within plus minus 10% of the calculated value can be considered as an intrinsic value of that company. Calculating the intrinsic value can be a very long and difficult process. It also has too many assumptions. You can also follow Benjamin Graham's theory if you don't wish to do all this. According to Graham, only buy stocks that have price to earnings ratio less than 15. But this is too conservative and not many stocks will be trading at P by E ratio below 15. So think accordingly. Thanks a lot for watching this video. Do like and subscribe to show your support. We'll keep making more videos on earning, saving and investing money. One stop to all your money problems. See you in the next video.